So far on this channel, we've talked about a variety of things that have generally skirted the topic of investing in Korean markets. This isn't because I don't understand them, it's just because I'm just a guy with a mic who has no right to be giving out any investment strategies or tips that should be listened to by anyone other than my dog. But for those of you who are interested, this is exactly what I'm going to be talking about today. You're watching Sekkider, and this is episode 5, Buyer Beware Part 1. Now, at first glance, the Korean market looks almost too good to be true on a number of levels. For one, the retail investor may look at standard indicators like price-to-book ratios and see that they're often so small that they're liable to buy Chevy Silverados to make themselves feel better. You may look at a stock like Kepco, see it selling at record lows in spite of a new government contract, and think, hey, this is a no-brainer, I should be buying this right now. You may even run a quick Google to check if your eyes are deceiving you and find that Korea is one of the most undervalued markets in the world. But all of these indicators should be screaming buy to everybody with eyes, so why doesn't it happen? Why is the market historically lagged behind those of our neighbors? Now, it's hard to know for sure, but there are a few reasons that I think may be significant contributors to the slow growth in the past, present, and future. First though, before I get into this is a big ass disclaimer. These are just my personal views based on the research that I've done. You can feel free to loot and distribute them amongst your friends as you please, but you should know that there is no one agreed upon reason for such undervaluations. I'm also not really an expert on this, so I encourage you to do your own research as always to come up with your own conclusions. Anyways, let's get past this. Let's start with the past. I'm going to start by talking about the Asian financial crisis. Now, without sparing you the details, back in 1997, there was a major collapse of Asian markets known as the Asian financial crisis. In November of that year, the Korean won inflated, the market tanked, the chaebols went bankrupt, and Korea was forced to take out a $60 billion loan from the IMF. You know the IMF, the ones that have ruined half the world. Anyway, unemployment tripled between 1997 and 1999 as government organizations and companies found themselves over-leveraged and lacking the reserves to gut out the rest of the crisis. To help alleviate the nation's financial burden, South Korea conducted a gold collecting initiative whereby regular citizens would donate their gold belongings to the government to help pay back the loan. People gave up their jewelry, wedding bands, and even Olympic medals to spare the country from the crippling poverty that often comes from inabilities to pay debts back to the IMF. They were able to raise over $2 billion through this initiative, but it was just another extremely visceral way that the crisis touched the lives of everyday citizens. The ramifications of accepting the loans led to a complete restructuring of the country's economic policy and turned it from a capitalist development state to the full-blown neoliberal capitalist society we see today. Now, this meltdown of the financial markets and the communal effort and sacrifice necessary to help pay off the national debt left a stain on many people's faith in the markets. These days, regular mans generally do not trust the financial markets or even really understand them. But can you blame them though? It's only been 23 years since the nation watched their markets collapse and their country go through collective sacrifice. Most of the young professionals I know, between 20 and 40 specifically, see the markets as too risky for them to park their money in, and it's necessary to have a somewhat bullish stance about the markets in general to even want to invest in the first place. These days, only 1 in 10 citizens actively invest in the markets. And this leads me to the next factor: real estate investing. So, unlike equity markets, which are extremely convoluted and the money is almost theoretical in nature to the average person, real estate has been a safe haven for investors in the years since the crisis. Not only is it a tangible investment, like you can stand physically inside of your purchase, but property values in and around Seoul and around the country at large have shot up so high that the government has had to implement numerous policies, taxes, and restrictions to help curb prices in and around the capital. The most recent policy as of August 2020 included a 60 to 70% taxation rate on owners of high-value properties, including those in so-called speculative areas. Suffice to say, while most potential retail investors and average citizens see the Korean stock market as prohibitively risky, there seems to be a general consensus that the real estate market is an absolute guarantee for growth. So much so that these new tax laws have done little to discourage wealthy investors from continuing as usual. In general, real estate has been the most popular place for investments across the past decade, But this might change as young adults are starting to become more aware that they've been priced out of the market and have, since the beginning of the pandemic, started flocking towards equity markets instead. Whether this is a trend that'll continue has yet to be seen, but if regular citizens return to the market, we may see a boom in the near future. I mean, it's booming right now. We're at all-time highs for the Kospi, but that might be because of foreign investors coming here as the US dollar drops. Who knows? Who really knows at this point in time? Now, turning towards the international side of the problem, another barrier to investment is the unavailability of Korean companies to foreign investors in general. Foreigners living abroad interested in investing in companies that aren't listed on bigger markets like the New York Stock Exchange are required to open an investing account either in person or through a proxy in Korea, and only then can they access the markets. As a result, fewer foreign investors are willing to jump through the necessary hoops to access the market when there are so many more readily available options. The most convenient way for foreigners to invest in the Korean markets is through diversified index ETFs and other indirect investment vehicles. Naturally, investing in the Korean market via funds is neither ideal nor attractive, but for all of the most determined investors. The final factor worth considering is North Korea. Now, our neighbors to the north may be the largest deterrent from investment in South Korean markets, or they could be the smallest on this list. Some studies, including those by the Korean Economic Institute of America, have asserted that provocations and tensions with the North have in recent years played little to no factor in the behavior of Korea's Kospi index. By the same token, those investing in South Korea do so with the assumption that the North and South will neither return to war or unify in the near future, the results of which would likely crash the market and destroy the value of any existing investments. Now, if the peninsula returns to war, there's also a likely chance that the export-heavy economy would fold, especially with nuclear powers on all sides of the fray. As I said earlier, investing is an exercise of confidence and requires a certain level of bullishness, whether investing in stocks, bonds, derivatives, or whatever the fuck. And while South Korea has proven itself stable over the past 20 years, I believe that the lasting sentiment towards the instability of markets domestically and attitudes surrounding North Korea internationally are real barriers that restrict the growth of Korean markets in general. Of course, institutional investors are extremely active. Korea's economy is one of the strongest in the world, and the options market continues to be one of the most active in the world. But if we've learned anything from the wake of the coronavirus, it's that the markets and the socioeconomic realities of the nations to which they belong are no longer linked as tightly as we once believed them to be. So, getting back to the fundamentals, yes, the Korean markets are some of the most undervalued and affordable assets out there. But should you invest? Well, that's just something you're going to have to figure out for yourself. Now that about wraps it up for this episode. Maybe you wanted to know all this. Maybe you didn't. Maybe you disagree with my arguments. Or maybe you'll end up repeating this between shots on your next Zoom call with your friends back home. Whatever you think, please leave a comment below and like and subscribe to help me keep this going. Thank you for listening. And don't forget to come back next time. I'm actually going to be talking about how to invest in the Korean markets if I haven't dissuaded you yet.